Welcome everybody. It's great to have everybody here. We're here for the third session in our reading group, the Money View reading group, in which we've been reading Minsky. Today we have with us Professor Dan Neilson. He's an assistant professor of economics at Bard College at Simon's Rock. You all know that. I want to quickly start today's conversation by offering my personal sort of reading, or very high level reading, of what Dan has offered in this book. I was the one who suggested it, and I want to give you a quick reason why I thought this was worth everybody's time to read Dan's book and engage in deeper conversations about the book. And we're really glad to continue that today in our third session. For everybody who hasn't read the book, just a quick sort of overview, but what I think the contribution is that Dan offers in thinking about Minsky. The first thing that I would like to say is that Dan makes it quite clear in the book that Minsky is attempting something by ways of making it clear that Minsky is trying to understand an essential feature about financial capitalism, and trying to make that start by the quintessential feature, which is shining through the book, the sort of analytical lens that we can apply to most problems, or as a starting point, is what Dan has worked out, the survival constraint, the need to make payments when they become due. And it's a very simple thing, but it's something that is so powerful and so maybe underestimated throughout the conversations and the rest of economics that that leads me almost to my second point, which is the struggle of these insights, the insight about the survival constraint, position making, layering, that are the three things that Dan highlights as sort of the thread throughout the book. How these insights have somehow either been completely ignored or only half-heartedly adopted, if at all, or even acknowledged within the economics discipline, even amongst those who heavily sympathize with them, which are the proposed Keynesians. And with that struggle, I would just like to highlight three things that Dan mentioned in his book, which is, number one, the issue, and these are all very nuanced things. I think only economists, we have several people from outside of economics who've joined the reading group, but for those of you who are economists, you might recognize it more clearly what those issues might be, especially if you're familiar with the money view. But the first issue is liquidity over solvency. The need to make payments today is not the same thing as not having your net value in negative. That's the first issue. Then this nuance, cash flow over income, is also something very powerful if you think about it. And the third thing that Dan mentioned is nominal over real. And that's just this whole bucket of issues of how Minsky engaged the economics discipline, which is to some degree also what we and INET are doing more generally, but Perry and Dan and others specifically are dealing with this issue within the money view of trying to make finance a more central part, and especially the survival constraint a more central part of our thinking about the economy. So that's the second bucket, how Minsky engages the economists. And the third thing that Dan works out quite nicely is Minsky offers a way of being an economist. I won't go into that more deeply because I'm going to let Dan maybe start on that point himself to try to explain that, because I also asked him, amongst the many questions we sent him, how does he view his own way of being an economist, and maybe how Minsky and also Perry has influenced him of being one. But I just want to offer this one little nugget of a quote from the book that I really love, which is, I'm paraphrasing here. Minsky had no interest in the mechanical application of theory. He sought the grand adventure. And I think that's a wonderful way to start the conversation, maybe, Dan. I'll post the questions here in the chat that I've sent to Dan, and Dan can sort of riff off of them. Initially, we don't necessarily have to follow a strict line, but this is just for all of us to see where the conversation has been so far. I mentioned at the beginning, if you're just dialing in, that the time was not sufficient to dig into all the issues we were thinking about discussing. So this conversation today might, I don't want to put a clear timeline on it, but I think maybe an hour and a half is the max, depending how long or how vibrant the conversation goes. With that, Dan, I would just like to sort of thank you for this contribution. I think we really enjoyed the book. If you haven't read the book, we really encourage you to start it or finish it if you're in the middle of it right now. We might come back to more conversations based on the book later. But I think just once again, the analytical clarity, but how you read Minsky and uh, how you allowed us to organize Minsky's work, which you acknowledge yourself, is not an easy way. There's no easy way if you're just starting to read them casually. Is a really important and helpful contribution for me personally. I think everybody that's been reading in the book. So thanks for that, Dan. So let's start with the first question,
Sure.
Which was how to be an economist, and maybe start with your own version and maybe Minsky's as well.
Sure. Thank you very much, Jay, and thank you all for being here. Some of you I certainly recognize from the two YSI events that I participated in earlier this year. And YSI continues to be an amazing source of interesting conversations and engagement. I feel like people are here for reasons which I share and which I understand, which is that we want to understand, we want to talk to each other, and this has continued to be a great place to do it. So I appreciate your welcoming me in. I think to answer the question, the written version that I have is, what is your style of being an economist? I'll give you a little bit of, let me put it in the context of how the book came to be. You know, I was I was a graduate student during the financial crisis, and had just gotten to know Perry at Columbia, where we both were. He on the faculty of Barnard, and I as a graduate student in the economics department, when the crisis broke out. And what I always liked talking to Perry as soon as I met him. But what I found as soon as the crisis really got going, you know, in 2007 and especially 2008, Perry had a framework, which is the money view. I don't think we quite called it. I think we started calling it that a little bit later, you know, but it was already mostly there. And the thing that I noticed immediately was that Perry, as a person, and his way of thinking as a set of ideas that could be learned and sort of put to use, really sort of unraveled these thorny situations in ways that many people were not able to do. Perry had a grounding in history. He understood finance, but not the way that you know, our colleagues who immerse themselves in stochastic calculus, you know, they might have an understanding of finance, but there's another kind of understanding of finance, which I learned from Perry, as many of us have. And I found that as soon as I started to follow that road, all of a sudden I found that I could participate in these conversations. At that time, a lot of it was about the crisis per se, you know, mortgage-backed securities and what the Fed was doing in response. I have held on to that, a big piece of that, and obviously, you know, none of this book, I'm pretty sure I acknowledge it explicitly, none of this book could exist without my collaboration with Perry. But also I think I've come a ways further on Minsky than Perry did. I never really sharply changed any of my views on Minsky as a consequence of writing this book. I didn't dramatically revise anything that I ever thought about Minsky, but I filled in a lot of the details. I have found in holding to that way of thinking about the financial system and the monetary system that I don't ever feel like I'm defending an orthodoxy or defending an ideology. And as a consequence, when I'm in a conversation where someone disagrees with me, I can actually just listen to what they're saying and try to understand what the argument they're actually making and what the beliefs and reasoning that they're actually using is and what it means. And when I am wrong, I don't find it too hard to let go of what I thought and adjust my ideas and conclusions. And so I feel like this way of approaching things is helpful because it lets me talk to people from a similar but also from quite different backgrounds and perspectives from mine. And I feel like it it it's easy to let go of little bits of it. I've never had to let go of the whole thing because it works, but but I'm also not in I'm not I don't have a stake in defending a particular ideology. And I think Perry would agree with that. And he and I agree on a lot of things. We don't agree on everything, but that's because we haven't fully understood each other yet. And I know in conversation with Perry, in conversations with my students at Simon's Rock, with YSI, with people who come through YSI, I feel like we're here to have a conversation and try to make sense of it all. And I've never felt like like there's some set of ideas with a name that I urgently need to be proven right, and I need to defend anyone who attacks it. And that I find that exceedingly tiresome about economics, and it's why I've kept my distance a little bit from the economics profession. It could be finance, it could be something else. For me, it's always been finance and money and banking. I have no There seems to be no limit to my fascination with it, even when I think the world might be better off without the whole financial system. Maybe this is a thing which shouldn't exist in the first place, and I sometimes feel that way, and I can defend that. But whether it should or whether it shouldn't maybe isn't necessarily the point. The point is there's a lot to understand, and it's fun to puzzle it through. So what's my style of being an economist? I love the conversation. I love genuine curiosity, which is not about gotcha. It's not about trying to pose a question that the person can't respond to. I find that to be just unbelievably boring. I'm here to connect with people and to talk to people and figure it out. And I find it truly satisfying to see something new, like Archegos or Greensill, these little pretty small financial kerfuffles that have come up in the last few weeks, and to just be able to sit down on a napkin and puzzle it out and say, oh yeah, I get it, I see what they were doing, I see why they thought they could make money, and I see why they failed to make money, and it all makes sense to me. And over, during my time at INET and as a professor and in my personal life, I have repeatedly found that I do understand these things. Archegos, I made sense of it in 20 minutes reading the Financial Times. I figured out what they did, and there are good guys and bad guys in there. I really don't care. I was curious about what they're doing, and now I understand what they were doing. They're going to lose a bunch of money, and they probably feel pretty stupid. That's not me, but I find it truly satisfying to just be able to puzzle it out. And when you're talking about money and finance, usually when you can write it out in T accounts, that is when you understand it, and that has been true for a long time. And also, it kind of shows like how limited the originality of these things is. Like, really, like that's all they did. They wrote swaps so they didn't have to hold it themselves. Okay, nice. I find that satisfying. And thinking about Minsky, you spend a year plus immersed in somebody's writings. Um, you have to constantly. I agree with Minsky on a lot of things. Right? I wouldn't write the book if I weren't a fan. So of course, but I don't agree with Minsky on everything. And even so, like, he had his own life and he did his own thing, and that's not me. But when you're in it for a year and my notes are just like chock full of quotes of Minsky, and I got a big box of like printouts of Minsky stuff, it is a constant effort in remembering, like, this is what I think and this is what Minsky thinks, and a lot of times they line up, and in certain places they don't. So I really appreciated during the writing, but also after. Now I have the book in my hands and I'm having conversations about it. I really appreciate having somebody else's entire career available to me, in my mind. I know what he did as an undergraduate. I know what he did as a graduate student. I've read his dissertation. I've read everything that he published. I read the stuff that he wrote in the last years of his life, when he was looking back on the younger things, that the things he had written as a younger person. I've met his widow, I've met his daughter, I've emailed with his son. And he made different choices than I did, and he had different interests and different beliefs than I do. But it's interesting to have another person's entire career in mind. uh, and I can see how ideas changed for him over time, and that tells me a lot when I encounter a new idea or I'm having a new conversation. um, I can sort of ask, what would Minsky do? And I'm not sure that I would defend that. I know a lot about Minsky. That's definitely true. I don't try to speak for Minsky. I think I say that pretty clearly in the book. Um, but it's really interesting to have that whole picture, at this point for myself, as I try to figure out my own things. I love teaching, um, which is an important part of my style of being an economist. I just think it's no fun without students. I've learned that although I teach undergraduates, I don't have any graduate. There's no graduate program in my college. So it's only undergraduates. They're often taking their first or second economics class. They have just barely noticed that there's a world out there. But their questions are very, very deep, and often they're poorly formed. They don't have the context, or they don't have the background. They certainly don't have the history. So you have to kind of watch your step, but it's just constant curiosity and constant engagement, and with some patience and attention. Teaching can be an amazing way to learn, and it has been for me. And it's so full of life. It's just like every day that I'm in the classroom is full of conversations and connections. Um, and so I guess I'm that kind of economist, whatever that is. In graduate school, I felt like they were trying to teach me to hate teaching, but I taught for Perry, and he didn't. He doesn't hate teaching. He loves teaching. We do it differently, Perry and I, but he loves teaching the same way that I do. And although all of my cohort were trying to get out of teaching one way or another, I just said, well, can I do a class that I'm interested in with someone that I seem to like? And Perry was a great mentor for teaching, and I've come a long way since those days, of course, um, but he showed me that it was okay to like teaching. And I would say, if you're going to be a professor and you're going to spend time teaching, you should learn to like it, because if you don't, then it's just going to be awful. I could just talk. I mean, I'm on sabbatical this semester, so I'm talking about loving teaching, but I haven't done very much of it. So if you let me talk, I can easily fill up an hour and a half without stopping. I'm a little bit deprived, but I don't want to take up the whole space. I would love to hear from people. I have more questions from your conversation, but maybe I'm just going to pause for a minute and see where we're at, and if people want to say something, and if it seems like it's time for me to move forward, just say so.
Yeah, we're a small enough group for people to jump in if you feel like you want to say something here. I do think there's one question that we had a discussion about last time. There was somebody in the last discussion that was a little critical, perhaps, of your general reading of Minsky. I think that fits here, that point. Whether or not this book, Minsky, is a sort of a money view reading, of you trying to realize your money view within in reading Minsky, and therefore de-emphasizing other important points, or whether or not you really did the job of really crystallizing out and making sure that the survival constraint was recovered from the work as the central piece. So maybe you can just comment on that. What would be your answer to that question?
I've been asked that question before. And first, as a preface, let me say there's no need to apologize for being critical or disagreeing with me. Uh, I wrote a book. I said what I think, and I have defended it to the best of my ability. I believe that what is in the book is correct, but I'm more interested in having this conversation than I am being proven correct. So please, you've all done me a great honor by reading my book and talking about it. Please let me know if you disagree. I'm happy to do it. The question is this the real Minsky, or is this a puppet Minsky that I'm making speak in Perry's voice? And it's a fair question. First, I would say that there isn't, other than Perry's article, which I've read 16 times by now, and relied closely on as I was planning the book. There's not what I would call a money view reading of Minsky that's out there, not as a sort of coherent thing. So if you say, Dan, you seem to have leaned a bit to one side on your interpretation of Minsky here. Are there not other aspects which might be emphasized? I couldn't really disagree with that. Yes, I think there are probably other aspects of Minsky that could be emphasized, which would make him seem perhaps less like a money view character. I think that it's valid to lean to one side when other interpretations of Minsky have leaned in the other direction. I go on about the post-Keynesians in particular about this because they claim him, and I think that that's not entirely fair. The way that the post-Keynesians claim Minsky as one of theirs. If you read his stuff, and I have, and I don't think anyone could say that I haven't read it carefully. In every single paper, he's talking about cash flows, about the timing of cash flows. He's talking about the arrangement of cash flows and the layering of related cash flows. And there's just no place for this in most economic theory, very much including the majority of post Keynesian. So, for example, Mark Lavoie's it's like a graduate textbook, kind of an overview of post Keynesian economics. He talks about Minsky and he talks about instability, but it really doesn't come from the same place that Minsky has it coming from in what Minsky actually wrote. So I guess one could say here, I think there's what Minsky actually said and what he was trying to do, about which I have an informed speculation. I've read a lot, I read the words that he wrote and I have tried to figure out what he was thinking, but I can't know for certain what he was thinking other than what he wrote. And there's another Minsky, which is how we put Minsky to use. And I have put Minsky to use in a certain way here, and other people have put him to use in a different way. I guess I wouldn't try. I tried in the book to be fair to Minsky. I tried to be accurate, but of course I was also selective. And I think anyone who uses Minsky is. I think that my selections are fair, are true to what I could understand of his intent. But another reasonable, informed person might make different choices about that, and I don't think I could really disagree. The third piece to this is that there's a way to ask what is distinctive about Minsky. What is Minsky doing that most other people aren't? Because those are the things that I think we should highlight, and that is very much in the spirit of what I've done here. And it's how I got to Minsky also, right? Because the reason Perry, I think, in my view, of course, the reason Perry makes a lot of use of Minsky is because of the affinity there, the shared perspective, and Minsky wouldn't have called it the money view, but I think that that's a very fair characterization. From the very beginning, Minsky was in the 50s. Minsky sat as an observer at a money market desk. He observed the new federal funds market at that time. He watched what actual trades looked like in those markets. In early stuff right out of graduate school, he was writing about cash flows. He was writing about securities as dated portfolios of cash flows, and about what that meant for the liquidity needs of participants in the market. I make this claim in the book, and I think I demonstrate it reasonably well in the book. That idea shows up in various disguises over the years. And I read everything in order, right? And if you look at when he's writing what and where he is in life at those moments, like where is he working, who is he talking to, he goes to Cambridge in 1970, I think it is, and like he comes back with a different relationship to Keynes, right? And if you do it in sequence like that, what I noticed is that he's got the same idea, the same kernel of an idea, which comes from Schumpeter and which comes from Simons, but which is really very Minsky. And it shows up, and I'm not the only person to have made this argument, right? It shows up as one thing in his dissertation. It shows up as another thing when he's in the money markets. It shows up as another thing when he's talking about Keynes, and so on. But it's the same thing. And if you read it carefully and take a step back, you can see that he's really trying to make the same case, but he keeps looking for a way to connect to other people about it. And he tries to use these different theoretical modes that economics provides over the years, always at a distance, right? So when he talks to the post-Keynesians, he says, yeah, I like the post-Keynesians, but the thing that I would add is this thing about liquidity and cash flows. And then he talks, he at other times, so in an earlier version, he talks about in his dissertation, right? He's working on the accelerator multiplier models, which are out of fashion now, but which were very much in fashion at the time. And he's trying to fit the same thing into different models. So when I think looking at that, I think it's fair to say that there's one thing that he thought was really important and other stuff that he was willing to change in order to try to talk to people because it wasn't any fun to do it alone. So he was trying to look for ways that he could make his case to different groups. And I can understand why he did that. He's not wrong to do that. But I wanted to talk about the thing that didn't change as much over the years. And it's actually, honestly, pretty consistent. The thing that he says it in the dissertation, he says it every decade after that, and he keeps saying the same thing. And that, I think, really fits into the money view. And that's just because I think they saw things the same way. Perry, and I, in my own way, and others of us who've contributed in some way to this body of thinking, have a history, at least as at some point as a reference point. We are interested in knowing what goes on inside these institutions. We talk to people who are actually sitting there. We read the news and try to make sense of what's coming, whether or not it conforms to a theoretical, a particular theoretical framework, and let the theory kind of come out of that. So I don't know. So like I wouldn't deny that I've leaned a certain way with Minsky, but I have reasons for doing it. I didn't do it without being aware of it. I have reasons for doing it. I think those reasons are fair, both to myself and to Minsky, at least as best I can. And I stand by it and would do it again, more or less.
Larissa, do you want to ask your question?
Oh yeah, I see. Go ahead. Well, I see it in the chat, but it would be nice to hear your voice as well.
Well, great to be hearing you. And as you're speaking, I just have a lot of questions. But one of the things that I was fascinated, because you followed quite closely his life, but you also connected with several people that were in his life. So I was just curious about what was different, or what did you learn that was distinct across the different modes of learning about him?
Yeah, the great disappointment that I experienced in working on this book was not being able to access his personal files. Because as a professor, the one thing I really wanted to read were his letters, his personal correspondence, and I never got to. So in terms of written stuff, I only had what he put in print and what has survived until now. From the family, I spoke to his daughter, and as I said, his daughter, Diana, his spouse, Esther, and an email exchange with his son, Alan. And what did I learn? The thing that I could never compute. It's interesting. I haven't actually been asked that question before, so this I'm thinking on the fly. But the thing I could never quite compute about Minsky is that he says multiple times, mostly in the 60s, he says capitalism is fundamentally flawed, essentially flawed. He says it in print a bunch of times. Essentially flawed, fundamentally flawed. I mean, you can't get around that, right? If it's essentially flawed, then you're done. Capitalism is flawed. It can't be fixed, right? Fundamentally flawed. That's what that means. But he never said, and so we should try something else, which would seem to be a reasonable conclusion, right? Capitalism is fundamentally flawed, therefore communism, therefore socialism, right? Why that would be the next step in the argument, you would think, because if it's fundamentally flawed, then therefore more regulation is not a good answer, right? But he didn't, as far as I can tell, at least in print. He never said, and so capitalism is fundamentally flawed, and so we should try something else. What I got from talking to mostly his daughter, Diana, was the sense that he wanted to be part of the conversation. He didn't think that his work in the economics, he wanted to be part of the profession. He chose to be an economist. He continued to feel like an economist, even though he was on the margins, even though at times he felt like maybe he was a laughingstock or like brought in just to make fun of. He said that somewhere. He wanted that, though. He wanted to be part of it. And so I think that his anti-authoritarian, maybe, or his radical self was expressed in other ways in his life, not in his economics writings, but in his relationships. Diana told me a story, which I think I can share, which is that she came home from school one day and had been instructed at school to ask her parents whether they were Democrats or Republicans. And her dad, Hyman Minsky, says to her, we're neither, we're radicals. Put that on your paper. Which is something he never said. He never said anything like that in print. You know, the farthest he went in print was to talk about anti-poverty programs. He complained about Reagan, you know, he complained about free marketeers, but he never advocated for radicalism in print that I could see. So I think there's another Minsky that he kept to himself and that he kept to his family. And I would like to know more about that, but I'm not an ethnographer. I'm not, you know, I'm not the right person to interview all these people in his life. Someone could do that, and I think that's not me. But it was reassuring to me to remember, you know, in terms of thinking about how to be an economist, it was reassuring to me to say, oh, okay, I've got a lot to work with here in terms of what he wrote to the economics profession, conference papers in journals, books, dissertation. You know, I can see the work of an economist here, and it's coherent, and there's a lot to say. And remember, there's also a life that surrounds all of this, you know, people, family, kids, colleagues, you know, which only occasionally show up in the published stuff. But he sat with people at Berkeley, at WashU, at Levy, right? He sat with people that he knew personally. He was a teacher. He had graduate students, so he had lots of relationships. And they're not, and the content of those things, the full life is not written in his academic publications. So there's a lot that we can see about Minsky, but it is in that way, it's a one-dimensional portrait, and it's not a biography. And I did not claim to write a biography, you know, and I was not asked to write a biography by Polity. So I don't think I've failed in my duty, but it's just that there's another part of the story that wasn't mine to tell. I would be interested to hear what someone could make of all of that stuff. It might be interesting. It might be interesting to know. I don't know. I'm a little unsatisfied by this dimension, so I could understand if you're unsatisfied by my answer to your question, but that's what I got.
Oh no, I think that makes a lot of sense. I was just curious if there was something that stood out, but I think your answer was it's fascinating to see that there is parts of him that were inaccessible in the writing, and I think that that's expected.
So I have a follow-up question to the idea of capitalism being fundamentally flawed. Does Minsky think that financial instability is maybe inherent to how the economy always has to work, or just in a financial capitalism context? Or another way to ask this is financial capitalism how the economy always has to work? And if we figured out a way to prevent financial crises, would Minsky say that, well, now you're not in a financial capitalism world anymore, or something like that? To what extent is he saying that financial instability can't be solved? To what extent is he saying that financial capitalism is the label that we apply to an economy in which it hasn't been solved?
Yes, that's an interesting set of questions, and I'm going to just tell you, I'm happy to talk about those questions, but I'm not going to be able to fully answer them. But let's see what we can figure out, right? What I think.
So maybe I'll say one more thing. Another way to put it is it possible to define financial capitalism in such a way that we can test whether it's always true that stability is destabilizing in that context? Like, you know, if we have an economy that has the features of the survival constraint and layering and position making, and then you have an economy that has all of these features, and then you figured out a way to end financial crises or something like that, is then that a version of financial capitalism that is, you know, not,
yeah, I think so. I think the way you've just posed it at the end there is a little narrower. So maybe I'll start there, because I think that we can, the ideas are more firmly pinned down there, right? I think that Minsky is pretty clear that, you know, there's a big asymmetry in the whole system. This is one way that this is my understanding, but I think it's fair to Minsky. There's a big asymmetry in that the push from private interests is always towards stretching money further, right? There's a one-way pressure in the system as a whole. And that's because people will work hard to make a profit, but there's not anything, people are not going to push themselves in the other direction, right? Regulators can push in the other direction, but that's a little bit different. So wherever you have a system where there's borrowed money, and something like cash, and a requirement that you pay, there's always going to be this pressure to make that go as far as possible. I think that that's enough to get, and in the earlier YSI events, I shared my little 2-sentence version of Minsky, and that's kind of what it says, which is that because of that push, which is always towards, stretching the money further, there's always going to be competing claims on a limited supply of the payment mechanism. I don't want to say money supply, right? Because we know it's not quite like that, but there's a certain amount of reserves, liquid reserves that are available, and a structure of claims based on them. And the pressure is always going to be more claims based on the same capacity of fixed reserves. So I think that's really enough to get the core argument that that there's got to be that financial crisis is a part of financial capitalism. So then I guess maybe the question, to like widen the focus a little bit, the question then is like, which of these things could you weaken or restrain in some way to maybe operate this thing safely? And Minsky obviously was very concerned with that question, and understandably so.
Right, like what if we tighten credit at the same time that we increase the amount of reserves or something like that?
Yeah, and I think you can do that. I think you can do that, and I think that can probably increase the stability. What is helpful about Minsky's analysis is to recognize that there can be a regulatory push that restrains, right? But the private sector push is always going to be in the other direction. I think you should bring in Minsky's observations about financial innovation here, because what that adds is that in a system where people can privately make private financial arrangements, right? They can write contracts however they want, like these equity swaps that I was thinking about last week. People can just write whatever contract they want, and so they will do so. The regulatory, you could think of it as regulatory arbitrage, right? That's one name for it. It's the regulators are trying to push down, and people will invent some way to go around it, some other direction, some new kind of contract to stretch reserves further. So the private sector push is to make the reserves go further. Regulators can push in one place or another, but if innovation is allowed, new kinds of contracts are allowed, then it's there's always going to be a game going on. So then I think this is now a little more me than Minsky, I think, because if you take a step even further back, I think what that says is that, when is the next crisis going to come? This is always the question, right? When is the next crisis going to come? It seems like it's going to come when enough people have forgotten what happened last time. The structures that we're working with now look different enough from what happened last time that they don't get noticed, or the private sector has moved fast enough that the regulators have fallen behind, or some combination of these, so that it doesn't look like it's the same thing again. Because that's a reasonable question with Minsky, right? He says, well, he says it's kind of always the same thing, more or less. Then why don't we, then why can't we stop it? But there's a fundamental reason why it's hard to stop. It's not just that we need better regulation. I'm not saying we don't need better regulation, but it's not just that, right? It's that it doesn't, like, we can contain the crisis. We can contain it just so long as we remember how to do it, But in the meantime, there's innovation going on, literal innovation, in the sense of like new ideas, new kinds of contract being tried out, which are all pushing in the direction of making more money available based on the same quantity of reserves. And at some point, that pressure is going to get out ahead of the regulators, and you just can't count on any countervailing. You can't count on bankers restraining themselves. They're not going to do that, and that is pretty obvious, at this point.
So I noticed that as soon as I mentioned tightening credit, you immediately went to the topic of regulation. But then there's also the question of, what if we tighten credit through prices and market mechanisms and stuff like that? Would you still have an equivalent problem of regulatory arbitrage or something like that?
Uh, well, I think that markets are not for. I'm not sure that market mechanisms are for tightening credit, right? Like when you think about interest rate,
Yeah, that's what I'm
interest
thinking
rates as a way to tighten credit. The Fed, the Fed has. They're not doing it now since the crisis. We've been pretty much at zero, but we're trying to get more credit out there in general, not less. But those interest rates that's not a market mechanism. That's an intervention, right? That's a not profit motivated set of transactions. It goes through the markets, but the reason that they're happening is because somebody is not interested. The Fed has a lot of resources, uh, can print money, right, and is not interested in making a profit. They're interested in stability. So
I should have said market interventions.
yeah, fine. So, but is that going to change it? I don't think so, because the Fed can certainly proved that at least up to a point they could affect credit through controlling a short-term interest rate. You can set up the price to credit and therefore limit demand. But whenever the price is higher, then you're also increasing the incentive to innovate, to find ways to stretch the money further, right? So as money gets more expensive, then there's more profit available to someone who can figure out how to stretch it further. And it's always possible to come up with some new contract that can move things around while limiting the amount of reserves that are necessary. So I guess I'm just not sure that we can get around. I feel like this potential and tendency towards instability. I think I agree with Minsky that it's essential. So I wrote a little paper which I can share if that's of interest about Polanyi, very different thinker than Minsky, writing from a very different perspective. But there was one thing in common, which was, I'm not going to try to repeat the whole paper. The idea that for this conversation, the idea that came out of that was that actually it's not even so much about finance in the end. It's about payment. And the fact is that all payment that uses money has always involved credit, right? And Perry knows this from monetary history. David Graeber's big book on debt makes a similar case. Payment, money, credit, debt, loans, this is all the same thing, and it always has been. So I actually think you could get most of Minsky's arguments about it just from the concept of payment itself, without, even in the absence of complex finance. Now, if we didn't have complex finance, if you just regulated out of existence banking, money lending on any grand scale, probably financial crises would not be able to spread in the way that they are. But nobody is seriously proposing that as a regulatory push right now.
So you mentioned that Minsky never proposed an alternative to financial capitalism. He never said, "Oh, it should be communism" or that kind of thing. Do you have an alternative? Do you have something that you would put forward?
I think it's not for me to offer a specific alternative, but I do. But I'm an activist. I have political. I participate in politics, in various ways. The way that I would connect it here is to say, I think it's really important to hold on to our imaginations, and I don't want to sit here and design an alternative economic system, and I don't think any one person should or could do that. But I think in particular, as people who study the way that the social world works, I think we need to hold on to our imaginations, in the sense that what we have is pretty contingent. If history had gone a different way, if different people have been in power at different moments in time, things could really be radically different than they are now. Graeber, I like Graeber, who, writing from an anthropological perspective, knows a lot about economics and finance and money. I mean, it's really what I would consider to be extremely well-informed perspectives. Graeber passed away last year, obviously, may he rest in peace. But really an extremely well-informed perspective about money and debt that I've learned a lot from. And Graeber observes, what the anthropologist's lens can see there is that human societies can work in very, very different ways than modern Western financial capitalism, which dominates our globe at the moment. People have found very, very different ways to live together and to do things together. So to say, there's no alternative, to say capitalism is the only thing that we could do, that is an extremely limited and not correct point of view. Humans that we could talk to and anyone could talk to, they might have had very different experiences in life than us, but no question, they use language, they have relationships, they have families, they're having human lives like us, but they can live in very different social worlds. So I find it very helpful to just remember that much of what we accept as necessary or take for granted as part of our world didn't have to be that way, and maybe doesn't have to be that way. In terms of what the actual alternatives are, there are interesting thinkers. Max Hyven is one who's collected ideas about I'm typing his name in the chat so you can look him up. Alternative money systems. Just how has money worked in different ways? I'm not sure that there's, in his writing, I don't think there's any idea that I would throw all my activism behind. I'm not for alternative currencies, that sort of thing. I'm not sure that would help. But I am very interested in having conversations with anyone who wants to think about it. And I think it's extremely important that we recognize that things could have been different and they could still be different. And we have more agency than it might sometimes seem, especially if we work in collaboration.
Can I follow up on that?
Yeah.
Because I think we're in a moment in time when there's at least a lot of talk of potential structural change. There's a lot of excitement around digital assets, or what digitization means for even new forms of collateral and new forms of money. So I would be curious for two things. One, what do you think would be Minsky's perspective on how much is different versus how much things are just, the same with different names? And then second, what is your perspective, if to the extent that it's different than Minsky's?
Yes. So I think so thank you for explicitly asking me to differentiate my ideas and Minsky's. It's a constant effort to remember which one is which. Minsky, what I could say for sure about Minsky, I was just mentioning financial innovation, and Minsky, what he said about financial innovation was kind of what I was just saying, that it's always pushing reserves further, right? So it's a source of instability. But what he demonstrated through the way that Minsky wrote over the years about different financial innovations, was that he was always skeptical, right? Every time somebody came up, and this I've adopted into my own life, every time that everybody puts out a new way of moving money around, Minsky comes out and says, this is probably going to lead to a crisis. And he had a whole brand of over predicting financial crises, but it worked for him and he made a career out of it. So I can't really fault him for it, but he definitely predicted more crises than actually occurred. But he was always looking for the potential for instability when some new idea came out. Mortgage-backed securities, now he was equivocal about it, right? He was looking for the instability, but he also said, well, look, there's this tranching idea, right, is a way that we could reassign risks, and so it's not inherently a source of instability. The idea itself is not a source of instability, but there is potential for instability depending on the way this idea is put to use, which is what we saw clearly. Also, I guess it should be said, there's a lot of securitizations out there, and not all of them were part of this crisis, right? That was a particular thing wrapped up in US mortgages and so on. For my own view, I just wrote a short piece. I started writing a little newsletter. So there's a link to the one that I just put out on central bank digital currencies a couple days ago. What I'm interested in sorting out about some of these, about quote unquote digital currencies. I'm interested in sorting out what is the difference between the technological innovation and the financial relationships that are enabled by them. So like if we think about this word digital, right? When people talk about digital currencies, what they seem to mean, one thing that they might mean is blockchain. They mean that the consensus about who owns what in the system is achieved through the result of calculations on a distributed ledger system. And the design of the system means that everybody's got to agree. And that's a helpful process, because if we know that everybody agrees, then that's a consensus, and we can see that there's not going to be disputes about who owns what in the system. But I guess I'm interested in, so I get that that's where people are pointing when they're talking about digital currency. But the word digital is not a good description of that, right? Because bank deposits have been digital for quite a long time now, right? Like I do a lot of things with quote unquote digital currency. So what is new here? What seems to be new about blockchain is that it's a new technology for distributing the processing work of sorting out payments. But if we're talking about state currencies, that's not really the problem, right? Like I don't quite get it, because like having a distributed ledger is not really the issue that people seem to be having with state currencies. I'm not quite sure what the issue people have is, but blockchain is interesting, and Bitcoin is kind of I'm fascinated by that. I think that's an interesting idea, and it's certainly like volatile enough that there's a steady stream of news about it, so that's fun. But if we get central bank digital currencies, and this is the point I try to make in this piece that I just shared, I'm pretty sure what we're going to get is something which is a lot more like a bank account, and it's not going to have blockchain. I don't think the Fed is ever going to be doing stuff on blockchain. I just don't, because because of the way the bureaucracy works and because of the tolerance for risk. I think what we're going to get is a database with just like a bank deposit, and so I think the innovation that we're going to see in the end is pretty different than the thing that people are imagining. So Adam, I see your question. I think digital is somewhat relevant, but like money is already digital, right? Yeah, what Alex said. Bank deposits have been quote digital for some time. So what I think the work is, and I think the money view and this is kind of the purpose of this newsletter in a way, is to try to be clear as we can about what the actual financial relationships we're talking about are, and do our best to keep a clear, like we should understand the technology, but sometimes the technology changes the relationships, and sometimes it's just a new way of doing the old relationships, right? So when in the United States we still use kind of a embarrassing amount of paper checks, right? We write checks on a piece of paper and give it to somebody, so that's a checkable deposit, right? You could do the same thing with there are numerous ways to complete that same transfer now using different technologies, but most of them don't really change the underlying economic relationships that are involved, right? So I can initiate an electronic transfer, it still goes through my bank, still goes through your bank, still goes through the same intermediaries. It's just like passing a piece of paper, but it doesn't involve the paper anymore. It's all uses digital communication, and is therefore fast, and has some other benefits. It also has, it has some consequences, negative consequences as well. Central bank digital currency, as I understand it, and the People's Bank of China is starting a pilot now. Details are still a little hard for me to be totally clear on. The Fed is probably a long way from an actual pilot. So I'm reading tea leaves here, right? It's a guess. But what I think we're likely to get is something where the technological innovation is not that great, but there could be at least one piece of the financial relationship which is pretty different, which is that end users, people, could directly hold an account, a deposit account at the central bank. And that's new, and I think it opens up new possibilities for monetary policy and stability. But it's a lot less showy, a lot less flashy, a lot less magical than I think people might think it to be. Tatiana says, I think there is some confusion around what are cryptocurrencies, stablecoins, and CBDCs are technology-wise. Yes, they are different. I agree. I completely agree. They are different. And I think it's I guess my hypothesis that I'm acting on is that I'm interested in understanding the technology, and the technology doesn't always tell us everything about what it's actually doing financially, what these innovations are actually doing, what these innovations are doing in the financial system. And so separating the two, the technology from the finance, is important. And then at the same time, advancing our understanding on what both of those things are is also equally important. And but what you can see, and I think, Tatiana, you're right to point to this confusion, but it's not just confusion, right? Because in that confusion, something's happening. For example, people are on about Bitcoin. A lot of people don't really understand it, right? My understanding of how the blockchain works is, I think I probably understand a lot more than most people. And even so, I have some questions still, right? So there's a lot of money washing around in there, and probably most of it doesn't understand what it's about. But there's this conversation, a confused conversation, which involves Bitcoin, blockchain, Ethereum, Libra, stablecoins, central bank digital currencies. All of those things are wrapped up in this one conversation. They're not all the same thing, but people don't understand it. And so probably what's happening is that there's a lot of noise about Bitcoin and volatility and Elon Musk and the whole thing, right? And then over here, central banks are going to do one little thing. Goldman is going to do one little thing. And somebody else is going to do one little thing, and nobody's going to notice because there's a lot of noise. And then Bitcoin's going to crash because it can only process 7 transactions a second, and because it consumes more energy than Sweden to keep the blockchain alive. It's not sustainable, and so it's going to break down. Everybody's going to lose all the money they put in Bitcoin. It's going to be gone, and what we're going to be left with is a few much simpler, much more straightforward ideas, which are not the same thing, but which appeared during that conversation. That's my hypothesis. I won't put a date on it because that would be a prediction, and I don't do predictions, but that's kind of what I think.
Just to update on the conversation yesterday, I think Adam's already alluding to it. We had Zoltan yesterday, and the same question was posed to Tatiana, and Zoltan was sort of in it as well. He says about the whole digital currency issue and CBDCs. He was basically saying he doesn't understand what the problem is that they're trying to solve, and nobody has ever nobody's ever put a white paper out to clearly specify what the problem is that they're trying to address. He's thinking that the system is actually perfectly fine in addressing most of the issues it's currently confronted with, and nothing's really out there from this sphere that he's really is catching his attention that would be a threat or a real incentive to change. Except for the one thing that maybe I think the one thing he did acknowledge was that we would have a better way of seeing all the transactions in one place, which could easily be solved, he says, by just having the major banks submit in a standardized way all their transactions to the central bank or something, whoever. So that's basically just an interesting conversation. We have it on YouTube now. We can check it out.
He was also worried that if there's an equivalent of everybody having retail accounts at the central bank, then does that cause problems for the commercial banking system? And he was maybe more worried about that than I would be.
Yeah, I agree completely. I tend to agree with Zoltan. We have comparable perspectives. He has different interests in some ways than I do, but he knows his stuff, and it sounds like what Jay just said characterizes a view which is very similar to my own. So if that's all accurate and fair, then I agree with Zoltan. It does seem a little bit like a solution in search of a problem, and one way to understand that would be to say, well, given that there's so much fuss about Bitcoin in particular, right, including confused fuss about it, it might be that I think probably the sort of stodgy central bank response at first would be, oh my God, let's wait till this goes away. and it hasn't gone away. And so now they can't just ignore it. And so what they have to do is say, okay, we're going to embark on a 10-year project to build a digital currency, and we're going to go as slow as we possibly can, which is totally justified from a central bank's point of view. They can't be just throwing out totally new forms of money. You can't throw that together and then run trillions of dollars through it. That's not going to work, right? And so it is a solution in search of a problem. And they're not implementing blockchain, right? They're going to look for something like deposit accounts at the central bank, and they'll come up with some ideas, and then at some point in the next 10 years, a problem will show up to which this is a good answer, and they've got it in their back pocket, and they roll it out. Or maybe it just goes away. Maybe they decide this was stupid, and let's let it go. China is trying theirs. It's a pilot, and they're pretty far along, which means they're probably going to do it. From their point of view, it seems to be about, and I want to get all the details in some kind of order on this because I think it's quite interesting. So watch my Substack for this. They seem to be worried about payment alternatives. So in China's society already, cash is very, very much pushed out, and it's pushed out by private mobile payments providers. Alipay, for example, right? So apps, we have these everywhere now, but in China, it's a gigantic fraction of retail transactions. I think part of what's motivating China is that they're concerned about the political implications of private financial services taking over so much of the payment system, and they've decided they want to engage in that directly. So they're shutting down private alternatives and building their own. And this, Goldman put out an analysis of all this stuff, and it was pretty poorly done, I thought. And it asserted that there's anonymity in these transactions for Chinese users, but I don't believe it, because I'm pretty sure that centralizing, having a single record of all transactions that could be visible to the central bank and surely also to the central government would be of immense value for surveillance purposes. And I don't see why they wouldn't do that. So I'm pretty sure that must be part of the motivation. I think, there would be more opposition, more better organized opposition to surveillance by the government if someone were to do that in the West. But at least in the United States, instead, what you're likely to see is advertisers wanting access to that data, right? Not necessarily the government, although they probably would want it. But why would advertisers not want to be able to see a single record of everybody's payments? That's, I think, at least part of the contest over controlling payment systems right now is access to that data, which really gets to the heart of people's economic activity.
So I want to completely change the subject and get back to something related to Larissa's original question, which got us down this road. In terms of you differentiating yourself.
Pause. Can I interrupt? Can I interrupt for 1 second? We're going to 1:30ish. Does that work for everybody? I'm fine with that. I just want to make sure that we kind of get to an end and then think about what comes next or whatever. But can we shoot for 1:30?
That's the original plan, but I personally could go longer, but it depends on you, Dan, and then the others around. But I think if we're trying to nail something down, I think 1:30 is good.
Okay.
You give a time constraint, Dan?
Longer, but I need to be done. I need to be wrapped up before. I have something at 2, so I need to be wrapped up before 2. But that's fine. That. Anyway, yeah. So Alex, please.
Yeah, so differentiating yourself from Minsky, what would you say are the biggest things you disagree with Minsky about?
Biggest things I disagree. Well, when we're talking about finance, I pretty much don't. Let me be more clear. The kernel of Minsky, which I put in the book, is for the most part the part that I really agree with. I pulled all that stuff out, separated it from other. Excuse me. And found something in it that I think I basically agree with, which is a pretty fundamental description of what finance is doing in capitalism and how it can be a source of instability. And I basically agree. I think Minsky spent a lot of time trying to attach his work to other, and I said a version of this earlier, right? He spent a lot of time trying to attach his work to other strains within economics. And I don't agree with that approach. I find it super tiresome. I find it tiresome to read. I went to a conference. I don't think any of you folks were there. I went to a conference in Milan in 2019, my last trip before the pandemic, in honor of Minsky's 100th birthday. And I couldn't find anyone to talk to except people that I already knew from Dirk Basimer was there, right? Like people that I already knew from INET stuff, or other similar channels. But like people were trying to fit all these Minskyan ideas into DSGE models, into all of these things, and I just can't. I don't know how he had the patience to try to do all of that. Why? Because I'm deeply critical of how economics has worked, both the ideas that it traffics in and the power structures within economics itself, and those two things are related to one another, right? But like a lot of what is standard or received wisdom in economics is false, is like falsified, is proven false, right? Is demonstrably not true. And so the effort required to like fuse these ideas into Minsky's good ideas about how liquidity and payment and finance work onto theoretical structures with no relationship, institutions or history or politics, seems like wasted effort. So, for which I pay a price, because there's an audience for the kinds of things that I write, as we are demonstrating. There's people to talk to, and I'm grateful for that. But is a little hard to get legitimation within the economics profession. The book that I wrote, I believe it's an accomplishment. I am proud of it, and my friends share that excitement with me. But am I going to be able to get and keep academic jobs with that book? The jury is still out. It's not clear. So we shall see. So I can maybe understand why Minsky felt the imperative to sustain those conversations, but I feel that they're wasted effort. And during my time at INET, I was fortunate to have great conversations with people in extremely interesting positions in the world. Adair Turner comes to mind, right? Like we went to Beijing and talked to top academics, people in government, bankers, central bankers, and I was able to participate in those conversations, and I was accepted as knowing what I'm talking about, and I knew what they were talking about, and like we talked about the financial system and communicated. We had ideas, we had hypotheses, we had guesses, but I understood and was part of those conversations. And I didn't get that from my macroeconomics class in graduate school. I got it from talking to Perry, reading the FT, digging into the institutions and like writing out the T accounts. And that is the thing that I learned how to do, that I still know how to do, that allowed me to participate in those conversations. So, and Minsky had his own way of doing that, but I still can't quite see like why he put so much effort into it. I wanted to just not leave hanging. There was a question or observation from Jay, and let me go back to it. Jay asked a while ago, we have an inherently critical view on the left of finance, which typically results in wholesale rejection of much of banking. How would a better understanding of finance inform left political outlooks? Yeah, and this I think is really important. I think there's a fundamental problem behind this. In the Polanyi paper, the thing that Polanyi noticed was he was writing in I was thinking about the Great Transformation. So he's writing in the 40s, and his question was, the World War I and the Great Depression brought the system to its knees, right? After 100 years of a global system operating, global conflict and global economic collapse seemed to crumble, caused the system to crumble. And Polanyi, I think, writing from a radical perspective, I think thought that the system was in the process of crumbling around him at the time he was writing, or at least that was part of what he was trying to figure out. Similarly, if you look at the 2008 crisis, if you follow that through to Occupy Wall Street, for example, in 2010-11, I think people saw this gigantic global meltdown and said, we are at the end of capitalism, similar to Polanyi's observation. And both times, not only were they wrong, but they were sort of completely wrong, like not at all. Like, if anything, capitalism is retrenched and more dominant post 2008 than before, in my opinion. Perhaps that's debatable, I guess, but so why, the recurring question is, why at these pivotal moments where capitalism seems to be fragile, why is the retrenchment so complete? And I think the answer is that, or part of the answer is, from the left, who are the people who during these moments might be saying, this thing is toppling, let's push it over, it's almost broken, let's be done with it now. I think that they have failed to appreciate the resilience of finance, or maybe they've appreciated it but failed to account for it in their response, right? And so if you look at what central banks really did during 2008, what they did was they preserved the idea of payment. They preserved the idea of finance when actual payments pretty much stopped, right? The money markets broke down. Banks wouldn't pay each other. They wouldn't lend to each other overnight during the crisis. One big bank would not go next door and lend an ordinary loan of $10 million, $100 million. That's what makes it all work, is that those banks will do that. And that stopped. It came to a halt. And only the intervention of the central bank allowed that to continue. I think people maybe have not quite appreciated that it's not so much about banks or even an amount of money or even a particular market, but at some point it's about the idea itself, the idea of finance itself, that has to be preserved. And the way that it's preserved is through a gigantic intervention by a non-profit motivated large balance sheet who can make the system last from one day to the next in a way that nobody else can. So, and at some point it's the idea of payment that we carry, right? That's a acculturated, socialized aspect of ourselves that holds it together. And that's the thing that's being confirmed by a large central bank intervention at a pivotal moment like a financial crisis. I think ideas on the left, critical thought on the left about finance, I don't think that we have to be a little more sensitive to the line between understanding how finance works and thinking that it's a good idea. And it's very hard to be, as I am, and as perhaps many of us are, to be at that position where, like, I can talk your ear off all day about mortgage-backed securities, and I think that the financials, and I have a left political perspective on the financial system. I think I know a lot about things that I think are bad, right? And so when you start talking about something because I know a lot about it, it will start to seem like I like it. And I guess I like knowing about it, but I would happily legislate these things out of existence if given that power, which I evidently don't have. So I think there's something about being on the left where we have to, and I hope maybe to contribute to the debate by being someone who can have that conversation where I do understand in my way to a certain degree, right? I do understand how it works, and I hope to share some piece of that so that we can have these conversations with more nuance and get to the heart of the matter a little bit more thoroughly, which has not always happened. And those with whom I might share political views, but who can only be, if all you can say about finance is it shouldn't exist, I don't necessarily disagree, but win the argument. And I don't think you're gonna actually succeed in your political objectives with that. It's a difficult and contradictory position, and I think we should be cautious with it, but I think there needs to be more people, or more conversation at least, around that edge, which is as informed as possible about what the system is and how it works. And in the meantime, maybe we can get incremental reforms and better policy response, which also could help people.
Do you think it's even possible to legislate finance out of existence? In your mind, can you imagine a world without finance and how that would look?
That, it's interesting, because it relates to one of these questions here. One of the questions that Jay had sent me yesterday was, the Fed can relax the survival constraint on everyone below them in the hierarchy, but what constraints does the Fed face? Is there something analogous to a survival constraint that applies to the Fed? And I think those questions are actually closely related, because let's start from the side of the Fed, right? What you notice, so everybody faces a survival constraint. You have to pay your debts when they're due. There's a limit to that, right? The limit for a big bank is that if you're a systemically important financial institution and you've overextended yourself in a crisis, probably you will find that you get out of some of your obligations to pay, because your systemic importance is judged to be more central to the continuity of the financial system than honoring contracts. For the central bank, their relationship to the survival constraint is different, because within a payment community, like, let's say, the euro area, right? The ECB has the capacity to generate additional euros on its own initiative, and therefore it can ease its own survival constraint directly. But the ECB is a good example, right? Because we know, if you look at how ECB conversations actually occur, it's not simple, but it's not simple for a different reason than it is for a big bank, right? It's not simple because it's hard to get Germany and Greece to agree on something, right? And so what that shows is that the central bank, by virtue of being at the center of the system, it is a political institution, and its constraints, maybe we shouldn't call it exactly a survival constraint, right? But its constraints are political. There was a moment during, there was the mortgage crisis, which affected Europe, and then the euro sovereign debt crisis kind of became its own thing, but it kind of grew out of that in the subsequent years. And there was a moment in there where there was reason to think that the euro itself would break apart. And the reason I thought that was because of the way the political nature of the conversations that were going on within the ECB. The ECB obviously is a single central bank made out of national central banks, and national sentiment is certainly not gone in Europe, and it plays a role in central bank policy making. So I think what has to be recognized is that the central bank faces a kind of survival constraint, but it doesn't look at all the same as it looks for other entities. It looks like politics. So could you legislate finance out of existence? Well, we could legislate like a local bank. We could legislate them out of existence. You could impose some kind of rule on some reserve constraint that they couldn't possibly meet, right? Or regulatory oversight that it would become uneconomical for them to comply with. And if there were a political will from government to do that, it would be kind of hard to stop them, right? So you could extinguish a single financial institution, but could you extinguish the entire financial system that way? I don't think so. You couldn't, because the political power of concentrated wealth is too great, right? That's especially true in the United States. Clearly, we give a lot of political power to wealth, but I think it's not really less true in Europe. That kind of power works a little bit differently in China. So I think maybe it's easier to imagine in that system, but not really even there, right? Wealth has a lot of control, and the private sector has a lot of control there as well. You can't stick your neck out too far. But even there, they're not going to shut down the private financial system. So at the moment that becomes the question, I think things would have to look very different, right? It's not just going to be Democrats organize themselves and they start going after the banks, and then one day they turn off the financial system. That's never going to happen. Instead, it would be associated with geopolitical conflict or technological change on an epic scale or major social change. And a pandemic was not enough to do it, right? So we're talking about something more dramatic than that.
So just to be clear, you kind of are putting forward the idea that these are all ultimately political constraints, that the survival constraint that's faced, or the equivalent of the survival constraint that's faced by the central bank ultimately comes from politics. And some of those politics are so entrenched that it's hard to imagine it would ever happen in certain contexts. And then similarly, the elimination of finance altogether, it has to do with entrenched politics is why it can't happen.
Just to be clear on Alex's question, to be even more clear with your question, Alex, there's no survival constraint so long the central bank can settle its debts with its own liability, right? That because the old gold standard case is, of course, an obvious example where there is a survival constraint.
Right. In the book, you even talk about the Fed or the central bank being able to force cash flows toward itself, and the way you frame that is in kind of controlling the scarcity of the liabilities that it issues. So that, I think that's maybe more what I was getting at. I was also the one who sent Jay that question about central banks and the survival constraint. So is there what are the economic constraints, I guess?
Right. Yeah. So I guess the thing that I'm saying is, what I think is important for us is to be attentive to the fact that economic and financial activity is always embedded in a political system. And sometimes we can kind of ignore that, but at the center and at the limits and during crises, it is not accurate to try to look at only financial relationships. And so we have to remember when it trips over into politics. In terms of the central bank's constraints, on a normal day, the Fed, the ECB, any central bank which is operating in a currency, operating primarily in its own liabilities, at least, technically has the capacity to create more of them, and so can't face a debt that it can't pay because it can just pay with more debt. The contract says when this comes due, what we're asking for is more of your liabilities, so they can do that. But so all right, so there are limits to that. One limit clearly is a central bank which is in one way or another involved in foreign exchange. So if you're committed to holding a currency peg that your liabilities, so Central Bank of China issues RMB, is committed to it's not a perfect peg, but it's a limited fluctuation in the exchange rate. And if you come up against that limit, then the central bank is going to have to choose either to let the peg relax or to issue more money, but not necessarily both. It might be difficult for it to do both. So that's one way that the central bank can be constrained.
And maybe the price level is an example of that too, because you can think of that as like the exchange rate with goods, that kind of thing.
Exactly. I do agree completely with that, except that a central bank can intervene in the FX markets today, and it can move the exchange rate right now if it wants to by just buying or selling until the price hits the level that it wants. And clearly the price level for goods doesn't respond in that way. But yes, I totally agree that conceptually, at least, you could think of it the same way, just on a different time scale. And so fixing an interest rate price is more like an FX price than a goods price in that way. You can fix the price right now if you can transact in the market. So Jay asks about the survival constraint being binding for the Treasury. The point, this one is contentious, and I have to watch out for this in my career. So let me try to be as precise as I can about this. The point that I tried to make in the book, and I haven't revisited my own text on this, so let me. Maybe it's not as clear as it could be. The point that I really wanted to make was that Minsky says that the Treasury faces a survival constraint. Minsky says that it does. Minsky says everybody faces a survival constraint, including the Treasury. And so the way he imagined that was that the Treasury intends to pay back its debts through tax receipts, future tax receipts, and if people don't believe, that the Treasury will be able to collect the funds that it needs to pay its debts from taxes, then they won't buy the debt. He says that in more than one place, but in particular, it's in Stabilizing an Unstable Economy, and that is what I quoted in my book. I say that because Minsky is invoked in an argument, is frequently invoked in an argument. I think it must be no secret on this call that I'm talking about MMT. Minsky is invoked in an argument made by adherents of MMT to say that the Treasury, effectively, they don't use the phrase survival constraint, but effectively the idea is that the Treasury doesn't face a survival constraint. And what they mean is that the central bank can always buy Treasury debt, and therefore the Treasury doesn't have to worry about its debt not being accepted, because the central bank can always print more money, and the central bank doesn't have to worry about that money being good because the Treasury can always demand it for payment of taxes. All the thing that I really there's a lot to say there, and people say a lot, and the thing that I just wanted to really focus on in the book is that I don't think you can use Minsky in support of that argument. That's not what Minsky said. You might believe that to be true, and surely there are interesting questions to be had in that, but don't put it on Minsky, please.
So just looking at the time, I think we're running out, but I do want to sort of give a quick sort of final question, maybe two questions about maybe the outlook and where we stand with the book. The first question would be, Dan, it's been almost a year or maybe over a year now that you've published the book. I think it's over a year, it's 2019. So obviously you have a slightly different view than when you were writing it, and you just mentioned that you've digested it a bit more. Maybe you can quickly reflect on that. What is it that you've now, I think you made a very good point at the beginning. What does the book now mean to you now a year later, and how are you going to continue to draw from it, or what would you do differently if you were to start that project again? The second question is, now with your Substack and your future projects, like what are you going to be focusing on next, and how can we maybe be involved in that process in your Substack? What are the things you're going to be looking at? What are the themes you're going to be putting out in your next project?
Thank you, Jay. Those are really really nice questions to end on. So I finished the book. It was kind of a year and 3 or 4 months to kind of do my part of the book, from the time that the proposal got the thumbs up from Polity. Proposal is like 6 or 7 pages, to the finished manuscript. And then, so that wrapped up in early 2019. Then it was about 4 or 5 months from there to having a copy in my hands, the pandemic showed up not very long after that. I got to talk about the book at a couple conferences, the one in Milan that I mentioned, and one in London in late 2019. And then the pandemic hit. We were talking about other stuff, and it was very hard for me, as I'm sure we can all relate to. It was very hard for me to feel like talking up the book was very helpful at that moment. But I thought a lot, and it kind of, I got sick of Minsky. His writing is terrible, and if you read hundreds and hundreds of pages of Minsky's writing, God bless you, it's just awful stuff. So I really wanted to kind of get some space after that. And maybe I've done that, and I did that, here in my house for the last year. But where I'm at now is that I think this, I have a piece of Minsky that I found, and which I believe is fair, and I'm happy to defend and talk about, as I've been doing with you folks, and I will do with anyone who asks. but I also, it's easier for me now a year on to see the limitations to what I have. Not that I disagree or that I'm wrong, but just that it's a couple hundred pages and it just can only be so much, right? There's more to say. Other people want to say stuff about Minsky. I'm happy for them to do that, and I would love to do it with them. I've said my piece and I stand by it, and you know, and there's room for others, and so I don't feel any. I have ownership of my ideas, which are expressed in this book, and I don't have ownership over Minsky or other interpretations. You know, I would request sort of respectful engagement, and can we all have this conversation together? I don't want to write another book about a single person. That was hard to do, and you know, the opportunity to write Minsky came up, and I couldn't say no. It was a very good opportunity. I'm glad that I took it and glad that I did it. But I will not go looking for another chance to write about a single person. I'm more interested, I think, now in following big ideas, big shifts that are coming out, and sort of keeping my finger on the threads, all these threads that we've been talking about today. So this motivates this, you know, what should we call it? Substack is a company, you know, it's a blog, but also a newsletter. And I would, you know, I am asking, I'm trying to get people to sign up, and they ask for an email. It's pretty transparent. You're not going to get junk mail from this. But having an email, you can sign up with your email, and it just lets me see who's there. And it's very different to send to an email list than to send into the void, you know? So if you can, I would appreciate it. It's free. What I want to do here, this responds a little bit. Perry and I had worked on a Money View blog back in the day, and I wanted to revive that idea. I have more experience now, particularly my teaching experience means that I am faster at puzzling out questions, things that come up. I can look at the news, and is much faster than it used to be for me to figure out what the story is and what is my interest. So part of it is just wanting to make sure that there's a voice out there every couple of days watching the news and translating stuff into T accounts. I think it's a Money View blog. I certainly don't claim to speak for Perry or for any particular set of theories. That's not, I speak for myself. You know, you'll have to make up your own mind. But Perry knows about the blog, and he's positive, so that feels good, of course. I want to just watch what happens and respond to what seem to be the current debates, and make sure that there's a Money View kind of reading out there. I've already gotten very interesting emails from new people and old people, tweets asking questions, and I love responding to those. And it helps push my thinking and recognize what I don't already know, and therefore can drive the next thing. And the discipline of trying to put something out twice a week on a schedule helps get things actually written. You know, if I know that there's a mailing list and they have some expectation that Tuesday morning and Friday morning there's going to be something in their inbox, that forces me to just get it done and get something out there, and that's very, very helpful. I think that the next bigger project, I feel like it is about the intersection between platforms, tech platforms, and finance. The observation is this: on the one side, on the platform side, you saw Facebook has been working on Libra, DM it's now called. They changed the name. It was called Libra for a while. Now it's called DM. I'm not sure what this is going to turn out to be, but Facebook, you just can't ignore a company with that much resources, right? So this is definitely in this like crypto space, right? But you see powerful platforms making moves to make stuff happen in the payments currency space. Clearly there's a lot of movement there, and there are big players involved. You can connect that to Twitter. Just think about Twitter's role in the 2020 election, right? You just can't ignore the significance of this aspect of the social sphere. I got to hear a few years ago now, 3 years ago maybe it was, I got to hear Marty Chavez, who was at that time he was the CFO of Goldman, but he has a tech background. What he had written some computer program for medical diagnostics that was really good, but took 2 weeks to run when he wrote it in the 70s. It didn't work because it was too slow. But if you run it on modern hardware, he claims, if you run the same code on modern hardware, it actually does pretty well. Marty Chavez, I got to hear him. He came to the college where I teach here, Simon's Rock. He came and spoke, and he said, Goldman Sachs is a data business. Full stop. And so, okay, that's interesting, right? Because here now I have a bank telling me that they're a software company, and I have software companies telling me that they're banks. So I think that this is highly contested. I don't think there's a single answer yet. I think that we're going to see. I think we're going to see where this goes. But if you look, we had earlier waves of technological change in the banking system, right? Digital, digital ledgers for bank record keeping, digital payment processing, and so on. All this has happened over the last 50 years. In 2021, the tech shifts that are enabled, if you look at the way the internet works now with Amazon Web Services, for example, super abstracted computing power. I think as banks adopt that, and I don't think they have adopted it wholesale. Goldman has unique resources, and so is maybe farther along. But as banks become data businesses more thoroughly, and they build that more into the underlying structure of their businesses, I think that could really change. That could really change things in money and finance. You see tech companies; they must see something similar because they're trying to get in from the same side. So to put it in Minskyan terms, I think we're looking at some kind of wave of financial innovation. And I still stand with Minsky that I think that there's going to be pressure on one side for this, and it's going to be a way to stretch money. But the technology is interesting enough and complicated enough and new enough and changing fast enough that I'm pretty sure we can't say yet where it's going to go. So I'm trying to follow that. I'm trying to follow what happens on the blog, on the Substack as I see things come out. I'm trying to just understand what comes up, and the idea is to get to another book once I have a clear sense of what this is about. To put out a book that would build out the argument and be a concrete step forward from Minsky. I would like the book to be a concrete step forward from Minsky that clearly draws on Minskyan ideas, but which is not about a single person, but which brings in other ideas as well, and then offers something, an interpretation or way of understanding this merger of tech and finance, which I think is going to be very important going forward. So to speak to something as Minsky did, right? To speak to something which is current and which is changing and which is important to us. So that's the plan. The discipline of writing twice a week is super helpful, and to have a connection to an audience and at least some kind of like back and forth during the process would be very different from what I experienced with Minsky, where I was all alone, just me and Minsky for a year. And I'm not sure that that's super healthy, and I don't necessarily want to do it the same way again. So that's part of the motivation for trying to put out small pieces that people can take in right away and get some responses and keep myself going through conversation with people with similar interests.
Well, we have an arrangement with Zoltan that at least every 6 months we check in with him on his global money dispatch, which we did yesterday. And we're trying to keep, he has the advantage that he's constantly in touch with somebody about what he's writing about. So I think he's getting his feedback, but I'd be more than happy, Dan, to check in with you about your blog posts, your Substacks on a regular interval. I think this would be super interesting. What you put out already is a really like right down our alley here. So thanks for that. Does anybody have any final thought, comment before we close?
I know, of course.
Well, great. Well, with that, let's just thank Dan once again for writing the book.
That's our applause.
I'm not sure if we're delayed now. I'm just hearing. Yeah. Anyway, Dan.
Yeah, my internet sucks here.
We want to thank you again for writing the book. I think you have a really receptive audience. I think there's a lot of people in YS that have now started reading it and are aware of it. we have these recordings now that we can go back to. I think we're going to digest it a bit further. I think me personally and others as well, to just sort of make these points really clear in our thinking about how we use that. In the similar way that you mentioned how you want to use Minsky, I think we want to start adopting him as well. It's really helpful also for me personally, because sometimes Perry, honestly, I read his piece as well. It takes a while to really really make it your own. I think that's why we're coming back to the course over and over again as well. Alex is leading the charge in May for us to take the course, like for the 5th or 6th time for myself, I think. I think we're all coming back to this because there's so much there. So I think we're all in this together. So Dan, thanks again. I think we're
well, thank you.
We're going to be in touch.
Thank you, Jay, for having me. I'm really glad to be part of this. As I said, it's really an honor. Honestly, it's an honor and very gratifying to have people read the book, but more than just to know that people are reading it, to hear back from them. You know, it's a lot of isolating work to put a couple hundred pages out there. It's just you know, it's writing and it's very quiet and like contains, and it really means a lot that here. It's now 2-3 years since I actually wrote that stuff, right? But to have people have the book out there and be able to have these conversations and you folks and others bringing your own observations, even just questions that come up while you're reading it, that my book could be an occasion to have these conversations, is the highest purpose, I think, for which a person could write a book. And so I'm grateful that you've taken the opportunity and invited me into the conversation. I'm happy to come back. I always enjoy interacting with YSI and the folks that come into it. So I'm happy to speak to any of you again. You can get in touch with me pretty easily. And I'm happy to come back and do events like this with you folks or with others anytime. You know how to find me. Thank you again.
Well, great. And we didn't even get to 10% of what we wanted to discuss again. That's fine because the conversation really took on a wonderful life of its own. I'm really grateful for it. So again, everybody, thanks for the almost 2 hours we spent together again. Just a quick announcement what the next reading is in the reading group for anybody that's listening. Also on the recording, we have decided that we are going to be reading chapter 4 of Ralph Hawtrey's The Art of Central Banking, written in 1933. That's a collection of essays. We're only reading chapter 4, which is itself a couple hundred pages, I think, more than 200 pages. So we're going to stretch that out over 2 reading sessions. And that's for 2 weeks from today. We'll be meeting again. Dan, you're invited if you have time. I think you might have read both. I remember you mentioning reading Hawtrey quite a bit yourself back in the day, and we're going to get into that ourselves as well. So you're all welcome to join that next project. And if you have any ideas of books you'd like to read, we're going to be just putting more and more books in front of us and just going through them together as a group. And the goal is to meet every other week. If, for instance, like today, we have a lot of questions we still really want to get at, we might use the off week to have an add-on discussion amongst the smaller group that is just trying to go deeper on some of the conversations we didn't get to. So we might use those off weeks. So again, that's just the next step in the reading group. And there's other things. Alex, do you want to quickly advertise maybe things that are happening in the related projects?
Yeah, so retaking the course is starting May 17th. I created a MoneyView subreddit which is going to be kind of the home base for operations. We haven't figured out actually how many times we want to meet via video meeting. Do we want to do one per every lecture and every reading? So that would be 3 times a week. Maybe that's a bit much. I don't know, but we're still ironing out the details. That starts May 17th. And then we also have the price level discussion group. So we've been doing some reading, and we had the authors of a paper in not this past weekend, but the weekend before. And our goal is really to try to figure out how to integrate the price level into the MoneyView. So that's a weekly, every Saturday discussion.
Yeah, and the next big thing in that group is that we're going to have Charles Goodhart talk about his new book, specifically chapter 5.
Yeah, Charles Goodhart and Manoj Pradhan are coming April 17th to talk about their book with us, The Great Demographic Reversal. Everybody's getting old. How's that going to affect the price level? Yeah. This weekend, this Saturday, we're talking about it amongst ourselves, and then we're having them in the following weekend.
Plenty of stuff happening in the MoneyView world. It's really great. And also, just so we are also completely in the picture. Larissa and I, but primarily Larissa, has started to take our notes. You've seen, the Google version. We're trying to transcribe that into a more open access version that we can share amongst ourselves and create some, catalog of our own notes and our observations in these readings. So we're going to be committing ourselves to that project as well. So again, thanks everybody for joining us here. We will see each other latest in 2 weeks if you're in this reading group, or on Saturday if you're in the price level, fourth price of money discussion. That's on Saturday, 9 a.m. Eastern, if I'm not mistaken. All right, Dan, thanks again. Thanks, everybody. We are going to
call it the link to the price level group. Hold on. Let me post that in the chat before we shut down.
Cool.
Thanks, everyone. See you soon.
Thank you.